I'm going to introduce you to a concept that's going to help take some of the decision making out of stock trading. Maybe you think, well, I want to buy some Apple stock, or I want to invest in Tesla. But when do I do it? Should I do it now while the stock is at its highest point, or should I wait? And if I wait, is it going to go down or is it going to go further up? How do I decide? The concept is dollar cost averaging. Dollar cost averaging is a buying strategy that lessens the volatility of stock purchasing by spreading the purchase out over a longer period, so that as the stock goes up and down, you're buying in at different points. Now, this is especially helpful when you're adding risky or volatile individual stocks to your portfolio. It works like this. If you wanted to own $10,000 of Amazon stock, well, instead of buying $10,000 today, you buy $2,000 this month, $2,000 next month, $2,000 the month after that, and so on. Until after 5 months, you now own $10,000 of Amazon stock. So what's the advantage? Well, it lowers your overall risk. We're going to play with a scenario to demonstrate how this happens. Let's say you bought your $10,000 of Amazon stock today while the price is hovering around $3,389. Now, over the month, the stock drops 10%. Yikes! You just lost $1,000, and that hurts, especially when you consider that it has to go up more than 10% to get your money back. Think about it. $10,000 becomes $9,000 when it loses 10%. But if $9,000 gains 10%, it's only $9,900. You're still out $100, and it's rough to lose money. Okay, but you're using buy and hold. So the next month the stock goes up 5%, and now you're sitting at $9,450. And the third month, the stock goes up 8%. So now you've got $10,206. And you're feeling good because now you're ahead of your investment. Of course, right when you start feeling good, the stock drops 6% for the fourth month, which leaves you at $9,593. In its last month, it goes up 5%, which takes you to $10,073, a wild roller coaster ride that ended with you up $73. Now, take the same scenario, but use dollar cost averaging. You buy $2,000 of the stock. The stock drops 10% this month, leaving you at $1,800. You buy another $2,000 of the stock. The stock goes up 5%. So now you have $3,990 total. You buy another $2,000 of the stock, and then you watch as it goes up 8%, bringing you to $6,469. So you buy again, $2,000, and then the drop of 6%, which takes you to $7,961. Your final buy-in of $2,000 happens, and in the final month, a climb of 5%, which finds you, after all is said and done, with $10,558. Compare that $558 return with the $72 return, and you can see how, at times, dollar cost averaging can work out for the best. Another benefit is the fact that because you're buying over time, you're less likely to be glued to the computer screen, living every moment in a state of stress while waiting for the stock to go up. You're more free to go live your life. Also, keep in mind it doesn't always work out this way. If the stock shoots up the first month, you miss out on some gains, but you temper that with the fact that you've lessened your overall volatility with the stock. In all, dollar cost averaging is a fine strategy to add to your financial toolbox, and it also is going to help build your wealth and grow your portfolio. Thanks for watching, and happy investing.